2021 was a stellar year for most equity markets, with the S&P 500 rising just shy of 30%. Small cap stocks were up more than 25%, although international markets underperformed, with emerging markets negative on the year. Bond markets, on the other hand, were relatively flat. Looking back over the last decade, the S&P has seen double-digit returns in 8 of the last 10 years. The last 3 years have been particularly strong, despite the coronavirus pandemic upending the global economy. Alongside these lofty returns in the equity market, we have seen some signs of euphoria that suggest caution. Valuations have increased as equity markets have marched higher. The price-to-earnings ratios of most stocks in the S&P 500 have approached levels reached during the 1999 dot-com era. The top 10 holdings in the index, including Apple, Microsoft, Amazon, Alphabet, and Tesla, have seen valuations increase more significantly over the last year, though not quite to the 45 times level reached at the peak of the dot-com bubble. These valuations are at least partially supported by the significant earnings most of these large companies have. Looking at the sector breakdown of the index, we can make another comparison to the dot-com era. In 1999, the technology sector was 29% of the S&P 500, exactly the same as it is today. But if we add to today's tech sector some of the large technology-like companies, such as Meta and Alphabet, part of communication services, and Amazon and Tesla, part of consumer discretionary, the weighting in the index would be closer to 41% of the total. Last year was also a record year for initial public offerings, or IPOs. Over 1,000 companies began trading publicly for the first time, far exceeding the number of IPOs in the dot-com frenzy of 1999. Many of last year's IPOs were done via special purpose acquisition companies, or SPACs, and have since seen their values decline. The cryptocurrency market has also provided evidence of speculative behavior. The total market cap hit a record $3 trillion in October of last year. Bitcoin and Ethereum are the largest and most popular, but there are over 16,000 different cryptocurrencies in existence. Many cryptocurrencies have sold off in the first part of this year, particularly meme coins that are less established and have no utility. One of the more encouraging signs that suggest the high equity market returns are deserved is the trend higher in profit margins. S&P 500 companies are expected to notch record profit margins in 2022, in spite of rising raw materials costs, increasing labor costs, and ongoing supply chain issues. Companies are passing price increases on to customers, protecting their margins and demonstrating pricing power, but also contributing to price inflation. We track inflation by looking at the headline Consumer Price Index, or CPI, and core CPI, which excludes the more volatile food and energy components. Both measures are up sharply, hitting 30-year highs. As most global economies reopen and demand returns to normal, prices for most goods and services have increased significantly. Higher costs for raw materials and energy have also helped push prices higher, as have supply chain issues that have stifled goods supply in the face of rising demand. The U.S. is also facing a very tight labor market, with workers in high demand in nearly every industry. Although total non-farm payrolls have still not reached pre-pandemic levels, job openings have surged to about 11 million, up from about 7 million 2 years ago. This has helped fuel upward pressure on wages, which helps drive higher economic growth and demand, but also contributes to higher inflation. After the 2008 financial crisis, the U.S. government passed about $983 billion in fiscal stimulus to help stabilize the economy. This pales in comparison to the nearly $7 trillion that has been passed in the wake of the pandemic, with another $1.8 trillion proposed. The massive amount of fiscal stimulus insulated consumer balance sheets, increasing demand and driving prices higher. In addition to the fiscal stimulus passed by the U.S. government, the Federal Reserve implemented monetary easing to support the economy in the wake of the pandemic. The Fed brought its benchmark interest rate to zero and injected money into the market through asset purchases. These purchases nearly doubled the size of its balance sheet, from about $4.5 trillion to nearly $9 trillion. After months of maintaining that inflation would likely prove transitory after the unsnarling of supply chains, the Federal Reserve shifted course and began telegraphing monetary tightening to bring inflation under control. One of the ways the Fed plans to tighten is by reducing the size of its balance sheet, either by selling assets or letting them mature without replacing them. Although interest rates have risen in the wake of the Fed's shift toward tighter monetary policy, real returns are still deeply negative. We calculate real returns by taking the yield on a 10-year Treasury and subtracting annualized inflation rates. With current inflation at 7%, real rates of return are near record lows of negative 5.3%. As a result, the bond market still has little to offer, and there is still no alternative to the equity market. In this environment, we are increasing exposure to companies with strong balance sheets, attractive valuations, and solid pricing power.